Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I am your host, Christopher A. Panayiotou, certified financial planning professional, the Cap in Capitalize. And on today's episode, I'm really excited for this one. We are going to talk about what to do with a bonus. But as always, before we get into the crux of the matter, your free advice for the week. Reanalyze your mid-year goals. Far too often, I see people make annual goals and they accomplish them early. That's not a bad thing at all. In fact, I'd say that's a compliment. Kudos to you if you're in that boat. But then what happens is people coast throughout the rest of the year and don't use this last half of the year to coast. And don't use this last half of the year to just wish it away. Make it a priority to better yourself before the year is over. And just because you got ahead of your goals doesn't mean you can't further compound your success. So now that we've got that out of the way, your free advice for the week, let's get into what to do with a bonus. So for most of you, and just most people out there with bonuses, it's generally a one-time thing per year, and it's generally at the end of the year. So what I want to do is I want to go over what to do and break it down by size of bonuses. As there's the range of bonuses is practically endless. So in terms of size of bonuses, I'm going to break them into 5 tiers. The first is $0 to $10,000. The second is $10,001 to $25,000. The third is $25,001 to $50,000. The fourth is $50,001 to $100,000. And then anything over $100,000 is the fifth and final tier. And as a reminder, as I go through this episode and I start layering in tips and tips and tips, everything I mentioned from the previous tier will compound into the next tier. And as they progress, it's just going to be cumulative. It's also worth noting up front that you should never count on a bonus, and you should live within your normal salary or wage throughout the years. So when or if, major if, you do get a bonus, you can simply supercharge your already phenomenal financial picture. Now, if just a quick little side note, if you don't have a salary or a wage and you are commission-based, whether you're an employee or a commission-based executive, this can be a little bit more difficult because, again, commissions are variable. It's not a steady Eddie salary or wage. However, just from my experience, the majority of people that are commission-based employees or executives for sure, they fall into the latter categories in terms of size of bonuses, which means that in many respects, financially speaking, you're probably doing better than the average salaried employee. So let's jump into tier number 1, $0 to $10,000. So the first thing you're going to want to look at is your high interest debts. And generally that's anything over 6 to 8%, depending on your comfort level in investing as well as personal finance in general. You're going to want to avalanche those debts, meaning order from the highest interest rate to the lowest interest rate. The reason why you're going to want to do this is that is the return that you are going to earn on that debt, or in other words, the investment that you're paying off early. So for example, if you have a credit card with a 27.99% interest rate, one, you should throw up, but more importantly, you should pay that thing off first because you're earning 27.99% interest on that debt that will be gone. And then you take all of that monthly cash flow, or in this case, a bonus that you otherwise would pay to that, and then you would roll it into and I'm making this up, let's say a student loan at 15%, so on and so forth, until you get to the 6 to 8% range. One quick note, because snowballing debts are really popular, and I'm not a fan of snowballing, which snowballing is you order it from the lowest to highest balance. So you pay the lowest off first. And there's emotional, psychological reasons as to why that could be valuable. But in the long run, you're actually doing yourself a disservice, because it takes the rate of return out of the question. And who doesn't want to earn the best rate of return on their money? Exactly. The only exception to that is, let's say that you have, and I'm going to make this up, let's say that you get a bonus for $10,000 and you have two debts. One is at $5,000 and one is at $5,100. And the $5,000 debt is at, I don't know, let's say it's at 15%, and the $5,100 is at 15.5%. When you're really, really close, and then if you paid off the $5,000, just hypothetically, and that frees up all the cash flow, it's so close that I would go and just pay off that balance as an example. But generally speaking, you want to go from the highest interest rate down. So I don't want to go too deep into that. Now, if you don't have these high interest rate debts, the next thing you're going to want to look at is, do you have your emergency fund set up? 3 to 6 months is ideal, whatever your expenses are. So if you spend $5,000 a month, that means you would need anywhere between $15,000 to $30,000 set aside in your emergency fund, preferably an online savings account, because you're earning a better rate of return on that interest. As for where you fit in the 3 to 6 months, that's really up to you. One, from a comfort standpoint, but then two, depending on what's going on in your life. If you're single and all you have is you to depend on, and let's say you have a really cush white collar office job where, I mean, you could basically be paralyzed from the neck down and still do your job. Hopefully we don't get there. But my point is, you could probably get away with 3 months. But let's say that you are married, you got a couple kiddos, and you are the primary breadwinner. Well, if you're out, and let's say you're in a very blue collar job where your body is literally on the line every single day, well, if that's the case, you're probably going to need 6 months. So you just got to toggle that. Now, once you have your debts paid off, or you just don't have that issue, and your emergency fund is already set aside, the next step is you're going to take your bonus and you're going to dump the whole thing into your company retirement plan. Now, depending on your situation, you're either going to want to contribute pre-tax, or traditionally, or Roth, which is after tax. And I really don't like giving blanket statements when it comes to tax strategy, but if I had to give a blanket statement on which one you should choose, because there's tax consequences to this. A general rule of thumb I see thrown around out there is, if you are in the 12% tax bracket or below, Roth is going to be your ticket. And then anything above that, you're going to want to contribute to your retirement plan pre-tax. And the reason for that is, again, going back to the high interest rate debt, anything that you put into your company retirement plan, if you're contributing pre-tax, that is the rate of return you're earning on the taxes you're not going to pay on those dollars. And generally speaking, 12% is the lower tax bracket range and below. And so you want to make sure that you pay the taxes at that rate today. And then when it grows tax-free and you get to retirement, well, instead of hypothetically being in a higher tax bracket, if you contributed pre-tax at 12%, you're never going to pay taxes like ever. Versus if you were in the 22% tax bracket and then you get to retirement and say you're in the 15% tax bracket in retirement, you just made 7% on money you're never going to pay the government. That's fantastic. Now, the reason that you're going to want to dump your bonus into your 401k versus other options out there, like an individual account, which we'll get into later, is there's a combination of things. One, the fees are generally lower. So think of your 401k as the Costco, buying in bulk of your retirement. So when you go to Costco, you buy in bulk, you buy at wholesale pricing. So your dollars go further. If you go to a mini store, your dollars aren't necessarily going to go as far per item because it's a more custom order, like an individual retirement account. So you want to make sure that your fees are as low as possible. That's why the 401k or 403b or 457b is going to be the right move for you. Also, you get a match. So most companies I don't want to say most, the majority of companies out there that are doing well have some form of match for their employees to have an incentive. So if you have $1 for dollar up to 4% or 50 cents on the dollar up to 8%, it doesn't really matter. The point is if you contribute your money into your company retirement plan, especially the bonus, you know you're going to get that match. It's free money on top of already the bonus that you're getting. And then the last reason is just the simplicity. Less is more. You don't want to have a bunch of accounts just floating out there. That's not going to be a recipe for success. You can invest in basically the same strategies market-wise in your 401k as opposed to an individual account. So by keeping it simple and investing accordingly within the funds that your company provides you, that is going to be plenty in terms of getting you to the promised land. So take your bonus, dump it into your 401k. Now let's get into tier number 2, which is $10,001 to $25,000. So again, on top of everything that I just mentioned for tier 1, this is where the dollar amount can make make an obviously larger positive dent in your financial situation. So depending on the size of the bonus, which again, 10,001 to 25, that's a pretty big range. Depending on the size, and if you were already contributing throughout the year to your retirement plan, you're going to want to put the entire bonus into the company retirement plan, or if you are able to, have the remaining amount of your maximum contribution go into your company retirement plan and max it out for the year. Now, we're going to discuss what to do with the money left over in a moment, but I need to mention this. So generally speaking, the majority of retirement plans out there are 401ks for private companies, 403bs for generally nonprofits, and 457bs for governmental institutions. In 2025, the maximum you can put in is $23,500. If you are older than that, if you're 50 or older, you can put in an additional $7,500, so $31,000. So there's technically a little nuance. I'm probably getting a little technical here, but it's worth noting. So if you work for 2 companies and one has a 401k and a 403b, that $23,000 is cumulative, meaning it doesn't matter where you put dollars, it has to not exceed the $23,500. 457Bs do not fall into that category. So we've actually worked with some teachers at colleges where they have a 403B and a 457B. You could put in $23,500 into each of them because 457Bs they're kind of their own beast. So just be cognizant of that. And I say that because if you do fall under that admittedly very rare circumstance, that is going to allow your plan to remain that much more simple for that much longer. Now, after your company retirement plan is maxed out, depending on your tax bracket, you're going to want to contribute to either a Roth IRA or a deductible IRA if you can get the deduction. If you're not able to get the deduction, I would contribute to a non-deductible IRA, which You're still contributing to an IRA. You just, again, you don't get a deduction. It's kind of within the title. And then you convert that money to a Roth IRA, and that's known as a backdoor Roth IRA. Generally speaking, those that are higher net worth are going to do a backdoor Roth IRA, because if you don't get the deduction, you might as well convert it to that Roth IRA, because if you make too much money, you can't contribute to a Roth IRA directly. So by doing that backdoor, you're putting money into something that, yes, you've already paid the tax, but it's going to grow tax-free until you get to retirement. And you have to have it for at least 5 years. So as far as how much is too much, in 2025, there are phase out limits. And I'm not going to get super into the weeds on how to calculate what the phase out is, but in 2025, if you are single, you have to make between 150 to 165,000. Anything above 165,000, you can't contribute to a Roth IRA directly. You'd have to do the backdoor Roth. If you are married filing jointly, it's 236,000 to 246,000. Now, into the next tier of $25,001 and $50,000. We got to keep adding these, but again, it's going to get a little bit more technical as we jump up these ranks, because these dollar amounts are starting to get pretty substantial. And at this stage, this is where it's going to get a little bit more custom according to your situation, because up until this point, you're doing the easy checklist, or what I call the easy wins. You're getting the easy wins out of the way. But with 25,001 up to 50 grand, with that amount of money coming to you in terms of a bonus, you could pivot in several avenues depending on the goals that you have. So if you have a short-term goal, and we're talking down payment on a home within a couple of years, maybe a down payment on a house, or on a car or a condo, something major coming down the pike. Because it's going to be short-term, so in a couple of years, you can't risk that money within long-term investments. If you try to invest long-term money for short-term goals, you are gambling, and you are just basically playing chance and Russian roulette with your money. We're not going to do that. So if you do have those short-term goals, you're going to want to, and it's very simple, you're going to take that money and you're going to add it to your online savings account. If you want to get a little cute with it, you could buy a CD or a money market or government bonds, or maybe even corporate bonds if you really know what you're doing. But the point with this is, if you do go the online savings route, it's going to be the easiest route. Again, it's FDIC insured up to a pretty large limit. So it's going to be the best route for the majority of you. You got to do some mental accounting. Anything above and beyond whatever your emergency fund dollar limit is, that money is basically going toward whatever short-term goal you're trying to achieve. Now, in terms of what short-term is, I would say anything within 7 years, or for sure within 3 years. And again, I don't want to beat a dead horse here, but it's really critical you understand this. You simply cannot risk that money from an investment perspective over that period of time. Now, if you don't have short-term goals on your time horizon, you could open up an investment account and invest it for a long-term goal, such as retirement. And you could do that with the stock market and further kickstart your retirement starting points. Because again, you maxed out your 401k, you did a backdoor Roth IRA, because at this point, you're probably going to have to do a backdoor Roth IRA because you're making too much. And then anything after that, you open up an investment account. And I would still keep things pretty simple. Stick to a stock market portfolio, whether it's a stock market, like individual stocks or index funds or mutual funds. You're kind of getting into the minutia. And at this dollar amount, I don't think it's really going to matter. You just need to stick to the long-term framework and strategies that we've talked about for years on this show. Now, before we go into the final tiers of 4 and 5, which I will excitingly warn you, it is about to get really real. We are going to take a quick commercial break, so don't go anywhere. Stick around. We'll be back shortly.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the show. We're going to get right into tier 4, which is $50,001 to $100,000 bonus. So at this point, you are hiking into some serious money-making territory. I am not degrading 25 grand to 50 grand. I'm not degrading 10 to 25. I'm not degrading really any bonus. I'm just saying, fact of the matter, this is where you're putting your big boy pants on. And the closer you're getting towards that $100,000 bonus, the more I'm going to say it, the more you have to start thinking about your tax situation. It's a non-negotiable at this point. So if you're getting a bonus between $50,000 and $100,000, you are going to want to call a CPA immediately if you don't already have one, because there's a really good chance that even though most bonuses withhold whatever you ask your employer to withhold for taxes, there's a good chance you're not withholding enough. It's as simple as that. And after meeting with your CPA or enrolled agent, if you want to use an enrolled agent instead, you can take whatever you think you're going to owe in taxes above and beyond what's already been withheld, and you can simply put that in your online savings account. And I hope this is not becoming the Chris's super pro online savings account, and this is going to cure everything, whether it's short-term needs, cancer, et cetera, et cetera. That's not what I'm getting at. But it's a simple tool, it's a boring tool, and it can come in handy for a lot of very immediate needs. Now, as stated earlier with short-term goals, anything above and beyond your emergency fund, you have to mentally account for. And you just know that, oh, that's the money that's going to go towards taxes. And tax payments are no different than other short-term goals that you have. And again, it's always depressing owing taxes objectively. But on the flip side, you are earning interest on money that you kind of know has already disappeared. So let's say, now I hope this doesn't happen, but let's say you get a $100,000 bonus and every single dollar of that is going to go to taxes. Again, you would have a slew of other issues if that happened, but just bear with me. If you took that 100 grand and you rolled that into an online savings account and it's earning 4%, now you would owe taxes. Let's say you get paid in December. So that's January, February, March, April. So you may earn, $1,000? Now, again, 100 grand just went out the door, but you made $1,000 off of interest on money that already evaporated going to the government. I just wanted to use that example simplistically to know that you can squeeze the blood out of the turnip for the taxman purposes by having your online savings account pay you money on the interest that is already going to go to the federal government. Anything above and beyond your tax money and everything else that we discussed, 401k, backdoor Roth, etc., you're going to want to look into the long haul. And I stated this before the commercial break, but I'm going to say it in a different way because it may click better for some of you. I don't know if that's the best English, but by definition, anything that you make above and beyond what you need for today, that's already been set aside for today, you can risk for the long term. So in terms of doing so, you could keep it simple with a stock market portfolio and regardless if it's a mutual fund, ETF, or individual stocks. There's getting to be some tax consequence if you're getting to the $100,000 range. But again, it's not as critical on which one you select. We'll talk about that later. You could keep it as simple as a stock market portfolio, or you could also look to add alternative investments to your portfolio, such as real estate, privately owned businesses, private equity, private credit. And that would further diversify your growth to your net worth by using a strategy I've talked about ad nauseum in the past called the endowment model. And it's something I use in my practice for not every client, because everyone's different, but I use it for a decent amount of clients. In full disclosure, I use the endowment model for my own net worth and my wife and my own net worth. As far as liquidity, we haven't really mentioned that. Liquidity is going to be critical for you. So the stock market should remain the engine to the growth of your net worth, but using these alternatives, it adds another layer of strategy that it could add some value. And I really recommend you go back and listen to our episodes on the endowment model. Capitalize Your Finances with the Endowment Models, I think the actual title. And that was, a couple of years? I think it was a couple of years ago. But it's worth listening to. And then the last strategy I would look into at this point is seeing which life insurance strategies could be most optimal for your situation. Now, for some of you, that could mean a term life insurance policy, and you simply replace the income for your family or your spouse if you have one. Because if you pass away, you want to make sure that income is replaced almost immediately. But for others, and I would actually say the younger you are, the more applicable this strategy is to you. You may want to look into permanent life insurance as well. And permanent life insurance can be used in a variety of different ways. Now, I'm going to caution you with something. If you speak to advisors, and these advisors start pitching permanent life insurance as some form of tax-free investment strategy, I would run away really, really fast. Now, could this be a piece of the pie in terms of usage for permanent life insurance? Yeah, it could. And there is some technical truth to that, but it's not an end-all, be-all investment. You've got to remember, life insurance, first and foremost, is life insurance, period. Permanent life insurance just has some secondary strategies attached to it. And with permanent life insurance, yes, you could use the cash value of your life insurance to grow and utilize that for some form of tax-free income in retirement, and in your income, in your portfolio could grow with some tax deferability. That is all true. But where I'm going with this is, if you are young and you're getting ahead of a lot of this, and if you have a family and you're trying to make sure that your family is taken care of from an estate planning strategy, there is a good chance that you are going to continue to compound your net worth in your high earned bonuses over time. So by the time you get there, and by get there meaning you're dead, your estate is probably going to owe some estate tax. And if you live in a state like I do in Washington State, where there's a state estate tax limit, which is significantly lower than the federal estate tax limit, you are going to be able to use your permanent life insurance as a tool to help pay your estate taxes. It's pretty cool. And last but not least, the final boss, tier number 5. If you have a bonus over $100,000, which again, that could range up into the freaking stratosphere. So on top of everything that I mentioned, you could also look to set up a college savings account for your kiddos, if you have kiddos, and if that's of any interest to you. as of today, 529 plans are going to be your best bet as investments grow tax deferred, and you can use that growth for qualified education expenses, and those are tax free. And there's a laundry list of what qualifies as a qualified education expense. Now, one thing that gets overlooked, this does not only refer to post-grad, like college, law school, medical school. This also applies to private school, kindergarten through 12. So if you have younger kiddos, and let's say that you know your kids aren't going to go to college, or they're going to go to trade school, which is significantly cheaper, you could actually start using that 529 plan for high school and maybe go to private school or things of that nature. So you can use it for a lot more than what used to be the case. Now, let's say that you have kids and your kids end up not going to school and you've saved up this money. One thing that you can do, you could take the money out, but you're going to have a penalty. And it's not huge, but it's annoying. So what I've actually recommended clients do is keep the 529 plan beneficiary as your kid. And then when your kids have kids, you just change the beneficiary. And then what's cool is, from an estate planning standpoint, your grandkid has, at that point, elementary school, middle school, high school, and maybe even college, all paid for tax-free. So it's a cool little estate vehicle. And then also, you can, if you've had your 529 plan for at least 10 years, you can roll up to $35,000 of that into a Roth IRA for your kid or grandkid if you're the beneficiary, or you for that matter, if you wanted to. So, again, one thing I did want to note too is if you have kids, if you have parents or grandparents or other family members that want to contribute to your child's education, I would much rather have you take their money and contribute to the 529 plan versus your own. But I'm going to keep going in the episode because that's a whole nother bag of worms that frankly won't be, that's above and beyond today's episode. Another thing, if you want to keep going down the kids rabbit hole, you could also set up a UGMA or UTMA account, Uniform Gifts to Minor or Uniform Transfer to Minors account for a kid. Now, depending on the state you live in, it's 18 to 21 as far as when your kid will get access to this money. And it's, at that point, they can do whatever the heck they want with it. So between 0 and 18 to 21, you could contribute to this and you could invest basically however you want to invest for your kids. I've also seen parents buy permanent life insurance for their children, and they use it as an investment for their kids. I get it, but again, insurance is insurance first and foremost, and don't try to get cute and creative with it. Now, at this level of bonuses and income, making over $100,000 in bonus, taxes are without a doubt going to be the greatest return on investment. And let me rephrase that. The taxes that you avoid are going to be the greatest investment that you can guarantee for yourself. So in terms of your stock portfolio, when it's not in your retirement account, so a taxable account, mutual funds are probably not going to be the best bet. And the reason for that is these mutual funds, what they do is they flow all of the tax consequences to you, the investor. Also, there are expenses with that, and you can't totally control the investments within the mutual fund because the asset manager who manages those mutual funds, their job is to manage the fund according to what the fund needs to have happen. You're not really the client. The fund is the client. I'm not saying that's bad. Full disclosure, my 401k is invested in mutual funds. I'm not against mutual funds at all. But what I'm telling you is when it comes to taxable accounts, when you're making this amount of money, you are going to incur unnecessary tax consequences if you choose the mutual fund route. You can do it, but I would much rather have you save on the fee side of things. So if that's the case, index funds or individual stocks are going to be a more tax efficient route. Now, in terms of alternative investments, which again, we're starting to get pretty technical, but frankly, if you're making over 100 grand a year, you can't afford not to get technical. All things being equal with alternative investments, you're probably going to want to shy away from strategies like asset-backed securities or private credit or business development companies. And the reason for that is they pay ordinary income. So if you're in the 40% tax bracket and you have an investment that's paying 10%, well, it's 10% minus the 40%, because again, these are top tax bracket dollars. So you're really earning 6% income. Again, this isn't in itself a bad thing, but I'm splitting hairs here because you've got to think about how to compare income to income from stocks, which are qualified dividends in most cases, or private equity or private real estate, where you can actually earn some deductibility on your income. And so now you're getting into what your tax equivalent income is. So a lot of people, I see this mistake all the time. They'll go, oh my gosh, I want to buy this because it pays 10% in income. Okay, well, why don't you buy this? They're like, well, because it pays 6% in income. Okay, well, you're not actually factoring in the taxes. So if you have a 10% income investment and it pays ordinary income at a 40% tax bracket, your tax equivalent income rate of return is actually 6%. Let's take that 6% investment and say that it's all return of capital or it's tax deferred and it's a real estate investment. Well, 6% plus an additional 40%. It doesn't jump up back to 10. It doesn't quite work that way. You're really earning a tax equivalent of 8.4. So when you look at it from a tax equivalent standpoint, real estate is, in this particular hypothetical example, would be your best bet from a tax equivalent rate of return. Tax strategy, tax strategy, tax strategy. If you need to get a tattoo on your forehead that says that, do it. Now, we're going to keep going with the tax strategies here. If you've been investing over the coming years and you have stock bonuses and you're looking to liquidate these, but you're worried about tax consequences, it may be worth your time to look into opportunity zones. And that can be a cool little strategy to help mitigate losses. And just to give you a brief understanding of how those work, 2017, the Tax Cuts and Jobs Act, there was this ruling or this law passed called the Opportunity Zone Law. And basically what it is you take a capital gain and you take that gain and you invest it into an opportunity zone, which is a place where real estate is deemed needed. It needs opportunities. So think of maybe a lower income or a rougher community, and you are taking a risk with that. So by taking that above and beyond risk, you take that capital gain and you defer that tax owed until, as of this recording, 2027. But there could be some more deferrability. I'm still reading through the big, beautiful bill right now, so I'll get back to you on that. But basically, the taxes would be owed in 2027. What's cool is if you do invest in that real estate, yes, you owe the tax at that point, but then that capital gain that you invested in that opportunity zone, what's cool about that is if you sell your real estate between 2033 and 2047, all of that growth on that new real estate investment is tax-free. All of the income is considered tax-free, and real estate gets old over time, no duh, and it depreciates. And so with depreciation, you are not taxed on that until you sell. And that is called depreciation and amortization recaptured income, section, I think it's 1250 of the tax code. And that's taxed at a different tax rate. But what's cool is you're not taxed on any of that either. So opportunity zones are a really cool strategy to help mitigate long-term capital gains. whether it's a stock, whether it's another piece of real estate, private equity. If you sell a business and you have a capital gain, you can utilize opportunity zones with that. Now, lastly, this is really technical here. If you, let's say you have a ton of ordinary income and you're an employee and an executive and you really don't have anywhere else to offset that, you could look into something known as a conservation easement. You could look into oil and gas partnerships. There are some unique tax strategies around deferring and potentially avoiding that tax altogether. And this is especially true and pertinent for those of you that have incentive stock options, restricted stock units, employee stock options, just to name a few. We're actually going to come out with an episode on what to do with stock options in the coming weeks or months. But due to the complexity and compliance, I'm not going to dive specifically into how some of those strategies can offset taxes with those unique circumstances. But all I'm getting you to understand, all I want you to understand is you need to think of these strategies and you need to at least have the bare bone understanding, because if you're going and talking to a planner or if you're doing this on your own, you're going to want to have these strategies in your back pocket. And frankly, if you don't have someone that understands all this, you're going to want to hire that person now. So that does it for today's episode on what to do with the bonus. I know we ramped up really, really fast and just in a major way toward the end of this episode, but it's worth noting all of this because a bonus it's an amazing fiscal God-given gift. And you need to be a steward of it, really like all of your money, but especially when you have these huge windfalls. So if you have any questions, you know where to get me at this point. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount of the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Information on investment products is for informational purposes only and does not constitute an investment recommendation or a solicitation to buy or sell the investment products described herein. Any investments or strategies referenced herein do not consider the investment objectives, financial situation, or particular needs of any specific person. Product suitability must be independently determined for each individual investor. Before investing, carefully consider mutual funds and exchange-traded funds and index funds or non-traded BDCs investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other important information, call your financial advisor. You should read the prospectus carefully before investing. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial, inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Master Limited Partnerships, MLPs, are complex products and are not suitable for all investors. MLP units carry notable risk as the units represent equity investments concentrated in the energy sector and may have complicated tax reporting requirements. Investments that concentrate on a relatively narrow market sector face the risk of higher price volatility. Earnings from a 529 college savings plan can grow tax deferred and may be withdrawn free of federal taxes when used for qualified education expenses. Non-qualified withdrawals are subject to a 10% penalty tax. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.